Hello, everyone. My name is Joseph Kamalafe, here with HC CPAs. And today we're going to continue our conversation. We're going to do part two of 1031 exchange. So we're going to focus on specifically the incomplete or partial exchange, the partial 1031 exchange requirements, depreciation recapture rules, and tax form 8824. All right, so initial or partial exchange. In the standard 1031 exchange, you need to reinvest 100% of all of the proceeds to defer all capital gains and taxes. In a partial 1031 exchange, you can decide to keep a portion of the proceeds. So if you keep a portion of the proceeds, you'll have what's called boot, or the amount of cash received, and that portion will be taxable. Any money that's reinvested into the other property that's being exchanged will not be taxable. All right. So incomplete or partial exchange. As an investor, if you don't want to defer 100% of the taxes and the depreciation, and you're willing to pay capital gains, then you can do a partial exchange where a portion of the proceeds will be cashed, and it'll be available for immediate use. So if you're an investor and you maybe have some medical bills, or you have a vacation that you would want to take that's long past due, or anything that might come up, you can, if you have a property that you are willing to sell, you can do what's called the partial exchange, where you take a portion of the proceeds and keep it for yourself. So you'll pay capital gains just on that portion, and the remaining amount must be invested in another property, and then that will continue the deferral, and you won't have to pay any capital gains or taxes on that portion. So the portion of proceeds will be available for use immediately, and the rest must go into the next property that you've chosen to invest in. So the requirements are similar to the regular 1031 exchange. It must be a like-kind property. The replacement property must be like-kind, which means that it must be of the same nature or character as the original property that was sold. The timing must be, the property must be identified within 45 days, and you must purchase the second property within 180 days of identifying after the identification, and the value must be the same or more as the original property. So debt on the replacement property must be the same as debt on the relinquished property. And then again, boot is any cash left over from the sale of the relinquished property after buying the replacement property. So the IRS considers the remainder capital gains, and you'll be taxed on the remainder. All right. So partial 1031 exchange, for example, if you sell a property for 400,000 and you want to use 50,000 of that proceeds for your child's college tuition, you can reinvest 350,000 into another property, and then the 50,000 will be taxed with capital gains. So another example, if you sell a property for 500,000 and there's a mortgage of 50,000, you can buy, and you have a mortgage of 50,000 on your current property, then you can buy a replacement property for 450,000, and the 50,000 difference will be considered boot. Will be considered cash received, and even if you didn't actually receive the cash, and then you would have the replacement property with no mortgage, be free and clear with no mortgage, but you also have to pay the capital gains on that 50,000. So the basis of a partial exchange, the basis is the price you pay to acquire a property. So normally when you purchase a property, the price you pay, including any legal fees, any closing costs, will be added to your basis. When you have a partial exchange, the basis is the price you pay. The cost basis of the cost basis of the property that you're getting is cost basis of the property you're selling is the property rolls over to your replacement property. So if you have a property and you purchase a new property, your original basis of your original property will then roll over to the basis of the second property. So depreciation recapture is a tax that applies when a property is sold and depreciation is taken during the holding period. So for example, if you have a regular rental property, 27 and a half years, you have to take depreciation. You're required to take depreciation each year that you own that property. And once you sell the property, then you have to pay that depreciation back, a portion of that depreciation back, which is depreciation recapture. When you have a partial 1031 exchange, the portion of the exchange proceeds that is reinvested for boot, and that portion is subject to capital gains and depreciation. The amount of depreciation recapture is determined by the difference between the sales price and the adjusted cost basis at the time of sale. Depreciation recapture generally is taxed at ordinary income, and it can be up to a rate of 25%. All right, so here is an example of the tax form once you do a like-kind exchange. It's the 8824. This is where the information will go on. So in this example, we have a 3-family home as a property given up, and you received a 2-family home. So we have the date the property was originally required, and the date you transferred the other property here, and then the date that the property was identified. So following all the rules that we talked about previously, this is property shown here. And in previous example, we have $50,000 of capital gains that will have to be realized in a partial exchange, and the remaining will be deferred and rolled over into the new property. Once the property is complete and sold, then you'll have to pay taxes on the $50,000 in this example. That is will be this will be a long-term capital gain, and that is part 2 of the 1031 exchange.
Thank you, Joseph.